Hello, everybody. How are you doing today? Hope everybody has had a fantastic week. I've had a really busy one myself. It is now the 13th of August for our live session together today. And I will be taking a break. I'll just remind everybody at the end of the session, but I will be taking a break from the live sessions next Friday because I'll be in Queenstown at a conference for most of the week. And on Friday, I'll be extending my holiday down in Queenstown to do a bit of skiing and holidaying with my fiance down in Queenstown. So we will take a break from the live next Friday, but I am here, boots and all, this Friday. So it is great to be with you again. It has been, as per usual, it has been a very busy week in the e-commerce space. I've personally been very, very busy this week. We've had a couple of launches with a couple of clients with some big projects. Some we'll be talking about next week in Queenstown at the Retail Global New Zealand event. And I'm really looking forward to this. It's been over 18 months since we've had any kind of big e-commerce in-person event, and I really, really am looking forward to getting down there and mixing it up with my industry friends and colleagues. But without further ado, I will get into the week's news. And then, as per usual, if anybody puts any comments or questions into the live stream, whether that be through LinkedIn, Facebook, or YouTube, then I'll come back to those at the end of the stream and address those just before I finish the stream at the end of the broadcast. So without further ado, we will get into the news of the week. Now, the first piece of news that I want to talk about is that the unabated investment into anything tech, anything e-commerce related at the moment seems to be rolling on, and there seems to be capital awash in the marketplace looking for a home, and anything related to e-commerce is getting a look in at the moment. And in fact, there was news released, I think it was yesterday, that Cart.com picked up 98 million USD in fresh investment to allow it to scale its business. That brings its total investment to date to $143 million. So that's actually its third funding round this year. So this was a $98 million Series B, and this follows the $25 million Series A, as well as a $20 million seed round earlier this year. So $143 million of VC capital injected into the business in 2021 so far. That's a heck of a lot of money for a business that bills itself really as commerce as a service. So the Cart.com CEO, Omar Tariq, he used to be an executive at Home Depot in the United States, as well as COO of Blinds.com. He co-founded the company in September of 2020. So, pretty late in 2020 with Jim Jacobson, former CEO of RTIC Outdoors or Arctic Outdoors. And he basically, Tariq said that it's commerce as a service. So basically bringing together products and services and platform all underneath the one roof. And in checking out their website, they offer the actual eComm platform itself. They offer order fulfillment and logistics, including warehousing. They offer marketing services. They offer merchant financing. They offer customer service, almost like that 3PL, 4PL type of service, plus e-commerce business planning. So they call it e-commerce as a service under the one roof. And they want to grow their business really rapidly. So basically, they want to grow their headcount by the end of this year about 15 times. They have just under 24 employees now. They want to be at about 300 team members by the end of 2021. And they've got 70 jobs listed on their website right now, ranging from engineering, technology, digital marketing, and e-comm. And Tariq said that about half of the new funding will go towards acquisitions. So they've already acquired a number of other related tech and services businesses and put it under their umbrella to bring that full suite of services to the market. And they say that they've already got 2,000 e-commerce brands on their books, including GNC, Haymaker, Coffee, and Kihi. And they process currently over $700 million in gross merchandise value per year. And they saw revenue increase 400% since the platform's launch in November of 2020. So basically, since the end of last year. So we're just over half a year through now. So yeah, obviously growing pretty quickly. They've currently have 9 fulfillment centers across the United States, and they're increasing their access to reach 80% of the US population with 2-day shipping. That is their goal. Now, in and of itself, this is just another piece of huge investment news into the e-commerce space. But when you look at, I guess, when you take the helicopter view of this and you get up above this announcement, this immediately reminded me of circa 2011, 2010. We're going back, a decade ago in the e-commerce world. This reminds me very much of the eCommerce fabric announcement by Magento, PayPal, eBay, and GSI Commerce. So it seems that there is nothing new under the sun in the e-commerce space. Most things have been tried before. Obviously, the eCommerce fabric just fell to bits. It was never able to be made to work by Magento, PayPal, eBay, GSI Commerce. So GSI was providing the logistics and the fulfillment. eBay was providing the marketplace functionality. PayPal was providing the payments infrastructure. Magento was providing the e-commerce functionality and the storefront. So that was the idea. The idea behind these massive companies coming together underneath the one umbrella, and effectively PayPal acquiring eBay, Magento, GSI Commerce. The idea was to tie this together through APIs so that at the click of a button, I remember back in the eCommerce days, I remember because I was working for a Magento Gold Partner agency at the time. And so what was coming down the pipe in terms of messaging from eBay and PayPal and GSI. I remember this entire discussion at the time, and it was, eCommerce was well ahead of its time. And in fact, in the show notes for this episode on LinkedIn, I will link you to one of the press releases at the time talking about the eCommerce fabric and the similarities between what eCommerce was trying to do and what Cart.com says that they are trying to do and are doing are absolutely striking. So it's very interesting to see, ideas and concepts get recycled in the e-commerce game over time. And, if eCommerce was ahead of its time, maybe Cart.com's time has come and maybe they are hitting the market at the right time with COVID and the increase in demand of e-commerce. But I will say one final note before moving on to the next piece of news, and that is that over my 20+ year, nearly 21 year career in e-commerce and digital, I have yet to see product companies that do professional and managed services well, and I have yet to see product services companies that do productization well. Companies really struggle with this. So companies that have a platform that also try to do implementations and try to do marketing and all these other services tacked on top, it is a really tough thing to do because the way in which product companies make their money is very different, and the margins are very different to the way service companies make their money and the way that they have to structure themselves to give fantastic customer and professional services. So it's going to be interesting to see whether Cart.com can pull this off, because I've never seen it be possible. And the problem is that you get taint from one division of the business to the other, whether you like it or not. And what that means is you might have the most amazing, in the case of Cart.com, you might have the most amazing shopping cart platform in the world. I'm not saying they do because I've never seen their platform and I don't know what it's capable of, but let's just say they had the best e-commerce platform in the world because they say they do B2B and marketplace functions and a whole bunch of other functions in addition to traditional B2C eComm. But even if that were true, and even if they had the best e-commerce platform in the world, if the services layer that is wrapped around this, if they fall apart on customer service, if they fall apart on their 3PL services, if they fall apart on their marketing services, and the customer is ultimately not happy with the level of traffic, say, that's being generated by marketing, or the conversion rate, or they're not happy with whatever, another department of the business, because at Cart.com, what they say is they do all of the design, they do all of the implementation, and they do all of the digital marketing, plus they do all of the fulfillment, logistics, and customer services. So that's all under one roof. Now, I don't know whether you have to take all those services as part of that service bundle with the because the website's not very clear about it. I did look at the website; it's not very clear. It says it's all available now. Whether when you sign up you have to take all those services out of the box, I'm not sure. But I just know that, and it goes the other direction too. You could offer the best services layer in the world. You could be doing fantastic marketing, you could do fantastic fulfillment, fantastic 3PL, 4PL services, customer service, etc. But if your platform is weak and it doesn't have the functionality that the merchant is looking for, then it can taint your services layer and tar them with the same brush. So I have my reservations about this. It's a heck of a lot of capital to be injected into a less than year-old company. So it remains to be seen whether they can pull this off or whether it's going to be money poured down the drain by the investors that have put in well over $100 million into this business over time. So it's going to be interesting to see whether they can do and pull off what eCommerce was not able to do circa 2010, 2011, 2012 in the Magento, PayPal, eBay, GSI environment. So it's always funny when you see patterns start to repeat themselves in your industry. So it's definitely a pattern I'm watching. I'm watching replay itself out, and I'm watching this one with keen interest. Now, the next one, we're going to talk about a few retailers next and e-retailers next. Now, Esprit, which is a Hong Kong-based company, they're actually listed on the Hong Kong Stock Exchange. Esprit Fashion, old school fashion brand. I remember even from school, all the girls seemed to like Esprit at the time. I'm probably dating myself here because I don't think Esprit is that popular anymore. But anyways, they issued a shock profit upgrade warning, primarily due to two things. One is they had some favorable foreign currency exchange rate movements that benefited them, and they called out specifically e-commerce wins in their profitability. So this would be their first profitable half year since the latter half of 2017. So it's been a long time since they've made a profit, so they filed this profitability alert with the Hong Kong Stock Exchange, and in the note they noted that they lost USD $463 million in the 6 months to June 2020. So, and that was mainly through write-downs of assets. And it expects the profit this year to not be less than Hong Kong 110 million or US $14 million for the 6 months to June of this year, 2021. Now, 10.9, so almost 11 million of that 14 million is due to foreign currency exchange rate gains. But the sales for the half year were still down 6% to US $488 million. So we're still talking a nearly $500 million half year USD business here. So it's not a small, it's not a small business by any stretch of the imagination. And Esprit's acting executive chairman, Kristen Chu, said this performance reflects accelerated growth in the e-commerce channel in the first half of 2021 with a 17% year-over-year increase in segment revenue. So that means that a good chunk of their profitability and their revenue performance is attributable to the e-commerce channel. So we'll keep an eye on Esprit. It's going to be interesting to see how they function in this world of fast fashion, how they can perhaps rebuild their brand, continue to allow themselves to be profitable outside of currency fluctuations, and can they build a sustainable business for the long term that relies on e-commerce and perhaps through their wholesale channels as well, and rebuilding their wholesale channel routes to market and potential D2C retail stores. And in that vein, the next story that I will talk about is probably one of my favorite brands in the whole world as it relates to omni-channel commerce, and that is Nike. So they've just announced that they're launching a sustainable concept store in Seoul, South Korea. And if you recall, I don't think I had talked about this on live because it was before I was starting to do lives, but they did announce last year that they were opening the Rise concept store. And I did cover this in a post to LinkedIn, or post or two posts to LinkedIn at the time. But last year they announced the Rise concept store in Guangzhou, China. and they are effectively upgrading the Rise concept a little bit further, which the Rise concept had a lot of new converged phygital experiences in store, online, but it was also a really sustainable store, and they focused on sustainable energy. They focused on a lot of recycling of their products and repair of their products and a whole bunch of other things that they felt were going to be important to the Nike brand moving forward in terms of the areas of sustainability. And they knew that that was becoming a much more important part of what their customers were looking for from them. And as part of this announcement of their new store in Seoul, they've announced a new quote unquote digital platform called Sports Pulse, which will help to continue to bridge the gap between physical and online store. And they say that they've improved the immersive retail experience through interactive RFID-enabled footwear tables called Inside Track, where shoppers can compare product details by simply placing products on the table. So I'm guessing they've got RFID tags on the shoes, and then the table detects the RFID tag of that particular product and then displays on an interactive display the information about that product side by side in an interactive, probably swipey, scrolly kind of a way. And in fact, one of the concept pictures that I saw had exactly that. It had one shoe on one side. It was a full, massive digital flat screen sitting on a table, flat on a table, and basically you'd walk up to it and you'd put the shoe on each end, and then it pulls up the product information based on the RFID tag attached to the shoe. Pretty cool, simple technology, relatively simple technology in terms of RFID tag, RFID reader, and then a screen that pulls up product information, probably from either the website or a PIM system. But still, just the way that Nike does this, they always take these relatively simple and straightforward ideas and merge them into a really cool, futuristic, almost sci-fi type of in-store experience in a way that almost no other brands are doing at the moment. So it's pretty cool. They also announced, as part of this, 3 new experience zones in store. One was called the Sports Hub, and apparently that will help shoppers connect with sporting opportunities in the city itself, where they can go and they can take place in sports in the city. Also, they have another zone called the City Replay Zone. It's a space to showcase hyperlocal products, and the Huddle Zone, a place for group or one-on-one expert sessions tailored to the customer's fitness goals. So I guess almost like personal trainers trying to help you get the most out of your Nike shoe experience. So that's pretty awesome. And in line with their improved or increased sustainability efforts, it will be one of the first Nike stores, Nike says, to secure a LEED Gold certification. And it is the first in Asia to launch a fully integrated service for recycling and donating of gently worn footwear and apparel. So shoppers can drop off gently worn shoes, and now for the first time, apparel as well, to the Seoul store, where the products can either be recycled or donated to partnering organizations that help communities facing disasters and other challenging circumstances. So I really like this concept by Nike. They're getting on board. They understand that they're pardon the pun, but their footprint in the world is not small, and they have an opportunity to really make a difference in the communities in which they operate. It's going to enhance their brand value. It's going to enhance brand respect. And then by bringing in these additionally converged online, offline experiences, they're creating more stickiness, more respect, more trust with their customers. So Nike seemingly doing just about everything right at the moment in terms of migrating away from their dependence on wholesale customers to a big and increasing focus on direct to consumer sales, both in store and online, through their apps that launch new drops, et cetera, et cetera. So Nike just firing on all cylinders and doing lots of cool stuff at the moment that's one of the reasons why I think they're just one of the best in the world at what they do. Now, on the flip side of the coin, we have Adidas not doing that well in comparison to Nike at the minute in relation to its Reebok brand. And in that vein, Adidas has sold the Reebok brand to Authentic Brands for $2.456 billion, which signals a $1.4 billion loss on the brand by Adidas after 15 years of ownership. And, Adidas was targeting they had paid $3.8 billion for the brand, but it does get them close to. In fact, it's slightly more than what they had telegraphed to the market that they were expecting to sell the brand more for, which was 2.4 billion. They ended up getting 2.456 billion. So they ended up doing a little bit better, I guess, under that bid scenario than what they expected. And they just didn't do much with the brand since they acquired it in 2006. And Jamie Salter, founder and chairman of CEO of Authentic Brands, who acquired Reebok, he describes it as an honor to be carrying Reebok's legacy forward. Important milestone for ABG, and we're committed to preserving Reebok's integrity, innovation, and values, blah, blah, blah. It's all the traditional fluff that you expect to hear from a major acquisition when you're spending over $2 billion for a brand. So obviously they believe that Reebok still has significant brand cache associated with it. Now it remains to be seen what they will do with it. How will they resuscitate the Reebok brand after years of falling sales, years of falling revenue, years of decreasing brand value, and decreasing, I guess, societal and cultural relevance by the Reebok brand as well. You know, Adidas doing well, especially with its partnerships. Its brand positioning is very clear in the marketplace. It's you know, nearly as famous as Nike in some markets, and in some markets even bigger than Nike, particularly in parts of Europe. Adidas is a absolutely massive brand, particularly in the football/soccer community. Huge brand, absolutely massive brand. So, you know, it's not a case of Adidas not knowing how to market products. I think it was probably just a dilution of focus for them off of their Adidas brand to have to think about Reebok at all as kind of the poor cousin of the Adidas brand. So, you know, now that a company is focusing solely on the Reebok brand, will it rebound? Will they be able to make it culturally relevant again? Time will tell. I think they're going to have to work with some heavy duty influencers, similar to how Nike and Adidas do it. So we're gonna have to see how they pull this one out of the bag, because it's a lot of money to pay for a legacy brand that has been stumbling over recent years. So we'll just see how and if they can pull that off, particularly from a D2C perspective, and pulling back some of that margin away from the wholesale channel. Now, next piece of news is Surf Stitch. Surf Stitch is an Australian-based marketplace, fashion marketplace, and they have just announced that they have partnered with General Pants to add 11 brands to the Surf Stitch roster, and they've inked a long-term, what they've called a long-term collaboration between Surf Stitch and General Pants, and the Surf Stitch says that they expect to work with new and existing brands to continue to broaden their offering on the platform moving forward. And Richard Faccioni, executive chairman of Surf Stitch parent Alchemy Group, described the partnership as part of a broader plan to grow Surf Stitch's consumer value prop via the marketplace. So, you know, Surf Stitch obviously playing in that super ultra competitive marketplace space in Australia, where there's many other hyper competitive marketplaces, and to ink a deal with General Pants, who has very well-known fashion brands in Australia, and putting those underneath their label. You know, I would have loved to have been a fly on the wall as that deal was being negotiated around maybe listing fees, selling fees, you know, what General Pants get out of the deal other than just another digital channel to sell through. I would have loved to have been a fly on the wall during those negotiations, but I'm sure that they did very, very well out of the deal. So we'll watch that one closely. Now, in what I consider to be a step backwards, and this one's been telegraphed to the market for a bit of time now. Huge Canadian retailer Hudson's Bay splits its in-store and e-commerce businesses into two completely separate business units, even going so far as to have them run under different names, and they're going to have different leadership teams, etc. So they said this week, it was just announced yesterday, that they're going to separate their businesses into completely separate business entities, one for in-store and /retail, another for e-commerce. But they did specifically call out that this was due to an increased focus on digital first transformation within the business. And the e-commerce division of the business will be known as The Bay, and it will be responsible for brand direction, marketing, buying, planning, and technology for both businesses. So, you know, on one hand, they're saying they're completely separating them, but then you have the digital division of the business being responsible for just about everything that relates to retail success for the physical retail stores as well. So it's going to be interesting to see how that plays out, because oftentimes when you have different business units, and in this case, they're separating them further than ever before. You have tension and competition between your retail teams and your digital teams. Now, if your digital teams are effectively responsible for physical retail success, now it starts to become potentially competing KPIs. What do these fiefdoms look like when people start to fight against each other to try to hit their numbers, and how does the blame game work in this environment? I see it as a step backwards. Most businesses are moving towards a converged phygital environment, phygital teams, combined KPIs, combined targets, combined goals, and seeing e-commerce as a supporting channel for the wider retail business at large. So it's going to be interesting. They say that their physical retail stores will continue, and there's 86 of them, so it's not a small chain by any stretch of the imagination, will continue to operate as Hudson's Bay. And they named a new president and CEO for the Bay, which was Ian Nairn, and Wayne Drummond is president of the physical stores business. So as part of their announcement, they said establishing e-commerce in stores as distinct businesses is a pivotal next step in the future of Hudson's Bay, HBC Governor, Executive Chairman, and CEO Richard Baker said in the announcement. HBC's digital performance and onboarding of new sellers has dramatically exceeded expectations. This move enables each team to make unencumbered strategic investments in their respective businesses to deliver an incomparable customer experience for Canadians. So, it sounds great, but for me, it sounds quite fluffy. And again, you've still got that interdependence of those teams to hit each other's numbers. So, does this separation bode well for the brand, or will it ultimately lead to disaster for both parts of the business, for both business units? Only time will tell. So coming towards the end of my time with you today, I just want to raise a couple of other announcements with you just before we finish off today. That is that the latest At the Coalface podcast episode dropped on Thursday, yesterday, as it always does, Thursday every single week, episode 91, where I was talking e-commerce marketplace performance analytics with James DeHardo from Merchant Spring. So go and check that out if you haven't already. It was a cracker of an episode. I am certainly no marketplaces expert by any stretch of the imagination, apart from the tech side and the integration side. I have never sold on marketplaces personally, so I'm definitely not what you'd consider a strategic expert on these marketplaces and marketplace merchantry, marketplace selling, marketplace strategy and tactics. But James he understands the marketplace landscape better than most, and obviously provides a SaaS technology that helps merchants that sell on marketplaces to have an analytics and business intelligence layer laid across their marketplace sales that they cannot get through the marketplaces themselves. So go and check out that episode if you haven't seen it already. It is an absolute cracker. And again, just to recap, there will be no At the Coalface live next Friday because I will be in Queenstown at the conference. And then on the Friday, I'll be extending that into a personal holiday with my fiance, Sarah. So looking forward to being down in Queenstown and spending some quality time down there. Be down there from Tuesday through Thursday at the conference, speaking in about 6 different sessions over the 3 days. So seriously looking forward to this as the first big physical conference I've attended since COVID began. So looking forward to hanging out with all of you down there that are attending the conference. So have a fantastic rest of your Friday or Thursday, depending on where you're at in the world. It's been a pleasure being with you as per usual. Now let me just go back to the stream and see if there are any comments or questions there. Somebody saying hi, so thank you very much. Hello, but no questions, no comments that I need to address. So I'll let you guys get back to your Friday. Have a fabulous day. It's blue skies out there. You can see behind me, it was absolutely hosing down with rain a bit earlier, and it was reasonably windy and nasty earlier today as well. So it looks like it is cleaning up, and hopefully we'll have a cracking weekend this weekend in Auckland. I wish you all a happy weekend, and I will see you in 2 weeks' time on At the Coalface Live, but I'll still be putting out my content as per usual on LinkedIn and other channels in the meantime. Cheers, guys. Talk to you soon. Bye-bye.